Hello, Alexander here once more. Uh, Accounting 202, Chapter 16, Statement of Cash Flows. Now, this can give people trouble also, but it once you get the hang of it and you understand each segment, then it's rather simple. It's just getting used to how it's put together. And we're going to be learning the indirect method, not the direct. And so um, it's one of the most important statements for business. The cash flow statement can tell you more about what a company's doing than any of the other statements: balance sheet, income statement, statement of owner's equity, because what the cash is doing in a company really is what matters. It's where's your cash going? Where's it coming from? And so, like always, we'll start with the intro, just because I love these are short. I like these intro sections. They're short and they give a lot of information. And so this is on the Jones Soda Company. Suppose you were to receive $100 from an event. Would it make a difference what the event was? Yes, it would. If you received $100 for your birthday, then it's a gift. If you received $100 as a result of working part-time for the week, then it's a result of your effort. If you received $100 as a loan, then it's the money that you will have to pay back in the future. If you received $100 as a result of selling your iPod, then it's a result of giving up something tangible. Thus, $100 received can be associated with different types of events. And these events have different meanings to you and different implications for your future. You would much rather receive $100 as a gift than take out a $100 loan. Likewise, company stakeholders view inflows and outflows of cash differently depending on their source. So companies are required to report information about the events causing a change in cash over a period of time. This information is reported in the statement of cash flows. One such company is the Jones Soda Company. It began in the late 1980s as an alternative beverage company, known for its customer-provided labels, always have a new picture on a bottle, unique flavors, love their strange ones like turkey and gravy soda, and support for extreme sports. And you've probably seen them at Barnes & Noble, Panera Bread, Starbucks, or maybe sampled them. They're not in all stores. They're kind of a specialty beverage. As with any company, cash is important to Jones Soda Company. Without cash, Jones wouldn't be able to expand its brand, distribute its products, support extreme sports, or provide a return for its owners. Thus, its managers are concerned about the sources and uses of cash. In previous chapters, we have used the income statement, balance sheet, and statement of owner's equity to analyze the effects of management and decisions and a business's financial position and operating performance. In this chapter, we're going to focus on the events that causing a change in cash by presenting the preparation and use of cash flow statements. So, on a statement of cash flows, there's three main categories. Cash flows from operating activities, which are transactions that affect the company's net income. Example, the purchase and sale of merchandise by a retailer. Cash flows from investing activities are cash flows from transactions that affect investments and non-current assets of the company. Examples, purchase and sale of fixed assets, such as equipment and buildings. And cash flows from financing activities. These are transactions that affect the debt and equity. Example, issuing or retiring equity and debt, which would be stocks and bonds. So basically, cash flows from operating activities would be accounts receivable, accounts payable, inventory, dividends payable, income taxes payable, anything receivable, short term, depreciation. You always add back in depreciation because you really didn't lose any cash on depreciation. And then gains or losses on sale of assets. So basically, under the operating mechanism, using the indirect. This is indirect I'm talking about. The direct method um, basically tracks cash down to exactly where it's from. So governments use the direct method. When I go over governmental accounting on one of my video series, it's going to use direct method. We're going to cover that one, and it takes way longer than indirect. Indirect is the essentialness of it is you're backing into the answer. Indirect is you're literally getting to the answer little step by little step, because you're looking at everything that brought you cash in versus everything that brought you cash out. Whereas indirect is you're taking things that either increase or decrease your cash, and then going from net income and backtracking from net income and tracing it back to where just the cash is left. It's like a filter. And so it's a lot easier because it's less stuff you have to dig up. And so operating, that we just talked about, that investing is long-term assets. So equipment, land, investments, big-time investments, intangible assets, and it's from selling them and buying them. And then financing activities is, once again, long-term liabilities and stockholders' equity. So stocks, bonds, paying dividends, treasury stock. So that's the three main categories. And then to start, so you start with net income on the statement, and then you add back in depreciation, because depreciation is not cash that you lost. Think about it. Depreciation, when you depreciate something, your cash isn't going down, yet it makes your net income go down. So you're taking the depreciation out of the income because you want to find that cash. So you're trying to turn your net income into what the cash actually was. So you add back in depreciation, you add back in any gains on sales of land or investments, because a gain isn't actually an increase in cash, it just increases your equity. So you deduct gains and you add back in losses. And then if your accounts receivable went up, it means your cash went down, because it's not cash you're getting. If your accounts receivable went down, it means your cash went up, because you're finally collecting on those receivables. The same is true for accounts payable. Accounts payable, when it goes up, your cash goes up because it's money you're not spending. When your accounts payable goes down, your cash goes down because it's money that you're having to spend to bring it down. Same with inventories. Inventories goes up, cash goes down because you're spending money. Inventories goes down, cash goes up because you're selling inventory. And so that's the indirect. It's the opposite. It takes a while to get used to, but eventually you understand it. And so it's the same for anything payable, anything receivable. And that's about it for just explaining it, because I'm going to do a little bit of problems and to show you, and I might come back later and do a big problem on it, but that's the basic idea of a cash flow statement, is you're just working back down from net income to the cash. So yeah, I'm going to do 4 little mini problems to kind of help give you an idea, and we'll go from there. So thank you. Make sure to look at a cash flow statement in your book if you can, and you'll see what I'm talking about. How a bond. You buy a bond, your cash is going to go down in the finance section. You sell your land, your cash is going to go up from the sale of land. That's going to be under investing. So, but thank you, and please comment if you will. Feel free to ask a question. I can respond. and like and subscribe if you will. And thank you so much, and I'll catch you later.